Hi, this is Tony Daly, and this is going to be a first in a series on volatility. And I'm going to explain what volatility is, and we're going to use Facebook, who just recently reported earnings, as an example. This is a daily chart of Facebook, and kind of looks familiar because this was when we did our drawings and we did the support and resistance. And I want to show you, this is as a result of earnings. We saw Facebook jump all the way up, and this is the most recent candle. It had a high of 110 and then it finished at 108.76. So this is what we're looking at now. This is the earnings, and then you see it jumped up on earnings. So let's take a look now and let's talk about volatility. Volatility is the market's estimate of price movement, and that's basically what it is. It's what the market prices in as an expected move, and it bases all of the options on it. So here, this is an option chain of Facebook, and this is today's. So if we look at it, we'll see the last price was 108.76. Here's the implied volatility, and they have implied volatility for each one of the strikes. And what that is it basically is an estimate of how much it's going to move. Now on the Thinkorswim platform, it tells you that. So think about it. This is today. The market, it has moved $4.82. We have implied volatility of 28%. And this is saying between now and expiration tomorrow, it's pricing in an expected move of $1.63. So you'll see implied volatility $1.63. But what was it yesterday before the earnings were announced? Well, we can do that with the Think Back feature of Thinkorswim. So we could actually go back in time, and what I did was, I've already done this, but I could actually choose any date in the past, and we could go back and play it forward so we could see exactly what happened. So I went back one day. Remember, Facebook announced earnings yesterday after the bell, and these are the closing prices before Facebook announced earnings. The market, this is kind of hard to see, but the market makers have priced in a $5 move on the earnings, and you'll see yesterday it closed for 103.94. Now let's take a look at the implied volatility yesterday. 85%, and it estimated a $5.67 move through expiration, which as of yesterday was 2 days because it expires tomorrow. So let's suppose you wanted to buy the call, the at the money calls would be 104. So you would have paid, let's just say $3. So you would have paid $3 for the 104 call. So think about that. That's what you paid, $3 for the 104 call, some midway between the bid and the ask. Okay, so Facebook announces earnings. Let's go to today. So where is the 103? We look at the 103 strike, and you'll see the 103 strike is 560 to 590. So what did we say it was yesterday? $3. So you'll see you actually had a gain of $3. But what's the volatility now? The volatility went from 85% to 28%. And let's look at this real quick. The at the money strike was $3, right? 104, it's $3. Let's look at what it is now. Now the at the money strike, which is the 109, it's only 65 cents. That's volatility crush, guys. That's when all of the volatility comes out of the market. Why do they do that? Well, they do that because whatever was not known is now known. Yesterday, when we were looking at the probability of, and we're looking at earnings, and you're saying, well, what do you think it's going to do? What do you think it's going to do? Do you think it's going to go up? Do you think it's going to go down? Nobody knows. But the market makers price in the volatility very high because they know that it's going to move about $5. And guess what? Look how accurate these guys. They priced in a $5 move. What did it move? $4.82. I'm telling you guys, the markets are priced to perfection. These guys are just incredible. Now, who would have thought that? I mean, you talk about, this is pure math. And this is about as good as it gets, guys. Now, could they be wrong? Of course they could be wrong. But it's just amazing that as of yesterday, they take all of the bid and ask strikes and all the different information that they have, and they use that to price in the expected volatility. And it comes out to the at-the-money strike is $3. So that's what you have to pay. Now, you go to today after they announce earnings, the price goes up $5. Now Facebook is just back to being a regular old stock. Now you want to buy the at-the-money call, now it's 65 cents. So when we say volatility is high, you're going to pay up for the calls, we're not kidding. You pay up for the calls. And third time you're going to go back and look. At the money is $3. Today at the money is 65 cents. Pretty big difference, wouldn't you say? So that's real important. That's a real quick and dirty look at how volatility affects options. And Facebook was perfect to look at because it just announced yesterday. Now let's take a look at Priceline. Priceline is going to be announcing, I guess in a couple of days. They'll be announcing in a couple of days. And you could look at this stock. So because they haven't, let's look at the volatility on Priceline. Now, here is this week's strike. It's the volatility is 26 and it's pricing in a 20-point move. Next week, the volatility jumps to 52% and it's pricing in a 94-point move. That's incredible, guys. So let's take a look at how that would affect an at-the-money option. So if you want an at-the-money option expiring tomorrow and it's $14.62, you're going to pay $10.70 for that option. That means that Priceline has to go up more than, let's just use $10.70. Priceline has to go up more than $10.70 for you to profit on that trade. But if you buy next week's with a 52% volatility and a 94%, you're going to pay $48 for that call. That's expensive. $48 for that call. And I could tell you that once Priceline announces earnings, it's going to drop right back down to its normal 26% volatility because that's where it usually stays. So when we say that as we approach earnings, volatility goes up and option prices get expensive, we're not kidding. You have to be absolutely crazy to spend almost $4,800 to buy one call, and you need a 48-point move in Priceline. Yeah, it's pricing a 94-point move, but you want to lay that kind of money out? I mean, you don't know what it's going to do. Now, some people would say to buy a straddle because you say it's going to go either way. Well, that means you're going to buy the at-the-money call and the at-the-money put. So add these two together, and it comes out to $93, right? 48 plus 46 with the change, it comes out to $93. Guess what? Pretty darn close, isn't it? And that's where these numbers come from. So that's what volatility is. Volatility is the market's estimate of how much it thinks the stock is going to move by a certain time. And whenever there is an unexpected event, volatility goes up and it gets much, much higher. After the event is over and we say IV crush has occurred, you'll see it. Look, well, this is an IV raise. We're going from 26 to 52. And I'll tell you, right after they announce earnings, these calls will go all the way down to nothing. And that's the trap that you run into. If you just buy a call and you pay $4,800 for it and Priceline goes up $40, you lost money because it went up a lot, but it didn't go up enough. And once all this volatility comes out of it, guess what that call is going to be worth? $10. You see what I mean? Or something like that. But that just gives you an idea, price movement. So it is a real disadvantage to you to buy calls by themselves when we're coming in front of earnings. So how do we get around that? Well, we get around that by buying spreads, because a spread is buying one strike and selling the other strike. So in this case, so let's say you got 1462. So I want to buy a vertical, and it comes up right down here, 1462 to 1465. It costs me 75 cents. We've done this math. We know how to do this. The math is the width of the strikes, which is 250, minus 75, means our maximum profit is $1.75 or $175 per contract if Priceline goes up above 1465. Well, look, it's at 1462 right now. Priceline moves $20, $30, $40 a day for nothing. And if you're bullish on it, you could just play this spread, pay $75 for a maximum gain of $175, and it's a one-day trade. Is it any different next week when the volatility is real high? Let's look. If I wanted to do this trade next week, when we have earnings in front, I'm going to take this one off. Now, instead of 75 cents, it's $1.25. So notice that because volatility went higher, all of these strike prices, the volatility rose, and instead of doing 75 cents, it's going to cost you $1.25 because we also bought more time. So this is a 50-50 trade. This is play 125 to make 125. We're buying the next week's at the money strike. We're selling the 1465. So what does that mean? That means that the price, if it's above 1465 at expiration, we make max profit. In this case, it's $1.25. If it's below 1462.50, we were wrong and it's worthless. If it's in between, you have to close it out. It'll be hopefully above 125, and anything above 125 is what you're going to profit. So your break even is the width of the strikes less what you paid for the option. So by having the advantage of doing spreads, we're able to trade stocks like Priceline without laying out $4,000, and we could participate. It doesn't sound like a lot of money, but if you do 10 contracts, now we're looking at a max profit of $1,200, and we're looking at a max loss of $1,200. It is a 50-50 trade. Okay, and let's go back and look at tomorrow's trade. Let's suppose you were bullish on Priceline and we wanted to buy this spread. So we buy this vertical for 75 cents. We do the analysis. Our max profit is $175. Our max risk is $75. Simple, simple. So that's the advantage of spreads, and that's why we're teaching you spreads, and it really lets you play in the big boys sandbox and trade these stocks. So who announced tonight? You know who announced today? Shake Shack. S-H-A-K. Let's look at that. So Shake Shack is announcing, and look at the volatility on Shake Shack. 188% because they announced today. Look at what the volatility drops to tomorrow, 95, and then it just keeps going down from there. But they really price the options very expensive. Now the stock is not a lot of money. We only have a 1 so here it is. It's at 50. Well, this is after hours, but it was, what did it close at? Let's look at the chart. The chart, it closed, Shake Shack closed at 51.11. So right before earnings, had you bought the 51, let's do more strikes. So had you bought the 51 strike, you would pay $3 for it. Okay, that's what you would pay, $3. So your break even is the strike price plus $3. That's quite an expensive option that you bought up there. Well, we'll see how much it pays off because it's bid at 54.60. If your strike is 51, you have at least $3.60 in real value in there tomorrow when it opens up. But unless it goes up a lot more, you're not going to make a killing. So do you understand why when you do regular calls, you take the strike price plus the amount you pay for the call, that's your break even. So right off the bat, you need Shake Shack to go to $54 or above. What did the market price? The market priced a $5 move in there. So you see how that worked? So the market thinks that it's going to move plus or minus $5 on the news. So that would take it to 56 on the upside and 56 on the upside and 46 on the downside. So that's pretty much gives you a basic idea of what volatility is. We're going to look at it a lot more in depth, but at least you get an idea of what volatility crush is, and ask some questions as we go. I want to end this now because we're at the 15-minute mark, and I will do another video on volatility, but at least you got an opportunity to see the difference between expensive options and cheap options, and how buying premium really puts you at a situation where you need the stock to move. That's why we use spreads to offset a lot of that risk. Okay, hope it helps. Give me some feedback, and we'll get to the next one once I am confident you guys understand this. Thanks. See you soon.